talk earnings and
the GAAP accounting.
favorite pastime.
So let me just say, earnings,
by
by the way,
Wall Street.
is
Why do they do that?
because their compensation goes up.
Wall Street's wrong again. We thought we'd do things a little differently for this episode of Altimetry Authority. Joel, we have recently just been doing a lot of research. Research, everybody, by the way, for context, that we've been working on in the background for over a year. And we're coming live with this big event. We actually just came live with it last week. It's an important special report. And so I asked you when we were thinking about this show, I said, hey, Joel, can we actually dive into it? And can I interview you as though it was just a conversation about what it is? So let's dive in. And Joel, for context, right, we have been in the middle of a roaring bull market for over 2 years at this point. In the special event and from the research that our team did, you highlighted that just in the last 6 months, right, there are hundreds of stocks that have doubled or more. And so, of course, the question everybody's asking is it too late to get in the market? So what did the research show, and how should people think about what to do right now in the middle of this roaring bull market?
Well, first, Rob, the research has been probably 30 years in the making, because you can easily go back to 91, 92, 93, 94 and see the beginnings of this, and actually make a really good comparison of 94 to 2000 would be really close to looking at sort of 2021, 2022, and then 7 years forward, meaning for another 3-4 years of seeing this kind of market anomaly. And the anomaly is that, people often say, that the market's in a bubble, or they say it's overconcentrated. That's the other one that I keep hearing. It's all the Mag 7. I'm like, if it was just the Mag 7, why is it that more than 300 stocks have doubled in value this year? 300, right? So I don't hear that it's like, it's just the Mag 7, it's overly weighted S&P. I'm like, well, hold on a second. Like, in terms of what an investor really experiences, all right, if you buy the index is driven by that. But if you're a stock picker, what a wonderful time to have 300 names to have been able to pick from that have more than doubled, and some of them crash after, but others just keep cruising. I mean, it's a fantastic market if you know what to look for, and that's what the research that we did was saying. Were there patterns in the 90s, in the 2000s leading up to 2007, and in what we're seeing right now for the next probably 3 or 4 years? Yeah, they're very distinct patterns. That's what the research shows, and that's what we're going to be showing on our event.
And I mean, I think to your point, you talk about that idea of it's a great time to be a stock picker, and that idea of those 300 companies and everything else. It's funny. Normally when people say it's a great time to be a stock picker, it's like, oh, you're going to be able to uncover, hidden gems or whatnot. And I think that's the important thing for this. This is a great time to be a stock picker because of, right, the thing that you keep on talking about in the event, everyone, for context, is the idea of the double anomaly. Right, and the idea that this is this tool that you can use as an individual investor that some of the greatest investors of all time have used. And but Joel, it kind of, I'll say, for probably not the right word to say it, but it kind of de-risks things. This idea of the double anomaly in terms of people's need to do work. Can you give everybody context about what the double anomaly is?
Well, it's just that the patterns that show you what has moved, if they continue, those stocks continue to move. And so instead of just looking at 6,000 stocks in the U.S. and going, okay, which one do I think will be discovered next by the big hedge funds and the big mutual funds that people start pouncing on, you can actually say, well, let's look at the companies that have already started moving. And can we discern between the ones that move a lot and then crash, or the ones that move a lot and then keep going? And I think those patterns are distinct. And the problem is you're not going to get it from Wall Street. Of those 300 names, how many did you ever hear Wall Street or CNBC or Bloomberg pounding the table going, you got to buy that stock? In almost every case, it's like after the fact, oh, well, look at this little company that we didn't know of. And they say that on every single one of them, right? When they realize, here's a company, I wish I'd saw this earlier. Wall Street is notorious at being late and then making it sound like, here's why. But, and then they say, but it's all the Magnificent Seven at the same time. Like, well, which is it? And the Wall Street research is just useless. Buy-sell recommendations from Wall Street are completely useless, and particularly during markets like this that we're in right now, which is akin to what the PC and internet revolution and .com did in the 90s. It's akin to what happened in the rebound from 2002 into 2007, and we're going through it right now. In fact, you could probably go back to even the 1920s, the Roaring '20s, and see similarities then in the patterns. If we want to go back that far, they're still relevant, these patterns.
Right, and this is the thing is, right, everybody always thinks about this idea of, you talk about the Roaring '20s, and everybody immediately fast forwards to 1929. You talk about, the dot-com boom, and everybody fast forwards to the dot-com bubble. And it's this missing idea, everybody, that, yes, every single chapter always has an end. But during that chapter, you could have, think about the returns in the 1920s. The 1990s, the NASDAQ was up 600%. And that's the important thing. Like right now, if you look, NASDAQ, everybody, from when ChatGPT was released in November of 2022, the NASDAQ is now up a little over 100%, right, including dividends. Yeah. And this is the thing is, so a lot of people go, oh no, wow, it's run so fast. But the secret is that's actually when you should buy in. And so, for context and just to give everybody a preview of Joel, what the work that the team has done and that you were presenting in our special event. So the idea of the doubles anomaly. I don't know why I can't say the word anomaly, and I keep on saying anomy. Sea anemones. The idea of the doubles anomaly is when you're in the middle of a bull market, when you find companies that double, guess what happens? There's a better than coin flip that they can double again. All that you do is you literally, everyone you were just to buy every single company that doubled, you would get an average return starting just then of 120% for the remainder of a bull market. And that's work that we did looking back really over the last 3 decades worth of bull markets. That's the dot-com boom, that is the post-crash right into the financial crisis when we had the consumer and financial-driven boom. That's the recovery from all of the 2010s, and that's post-COVID. And it's a staggering thing. And so everybody, if you want to see Joel's presentation in full, which goes into it in a lot more detail than we're going to go through here and really gives you the opportunity of what we think what your action should be to take on it. You can go to profitsbreakout.com. That's PROFITS breakout, BREAKOUT.com. It's at the bottom of the screen. You can see it, and you can see Joel's whole entire presentation. But Joel, just to continue, right? This is our team has, built a track record. I say this as a person who's part of the team, in terms of being able to, in just the last year and a half, we've had 20 triple digit winners, right? 20 times over across our Altimetry portfolios where we've been able to identify it. Can you, talk about, what, as we look at what the team does, what you think the secret is and how that dovetails with this idea of the doubles anomaly?
Yeah, Rob, the name of this website, Profits, or the link, profitsbreakout.com, is appropriate. Because at the end of the day, it's still about going after companies that have massive profit, I'll say, breaking out, but you only see it if you're using uniform accounting, if you're looking at the cash flows of the company. And I'll tell you right now, you won't see it if you look at the statement of cash flows. The as-reported statement of cash flows, you won't see it. And people are like, well, what do you mean? These companies don't have cash? No, it's the accountants have so muddied up the statement of cash flows that it is no longer an actual statement of the cash flows that it says. And they're like, what do you mean the statement of cash flows isn't cash? I go, no, it's the categories. Cash flow from operations doesn't represent cash from operations. Now, if you actually do what we do, uniform accounting, and you say, I want to look at the true cash from operations of the company, I don't want any non-operating cash flow in there. I don't want to see financing or investing in there. I want to separate between how much is the company investing and how much is it generating, and not muddy that concept, which is what the CPAs, my profession, has done, right? The CPAs have done. You won't see these companies. So we say profits break out, but it's not the GAAP accounting profits that you're looking to break out. It's the true earning power of the company, which requires restating the financials for 6,000 companies to find the 300 that are breaking out. And that's when you see, because a lot of people sometimes are like, well, these companies have super high valuations. Like, what do you mean by high valuation? Like, well, it's a really high PE. I'm like, yeah, but did you calculate the E correctly? And like, what do you mean? I'm like, were you using the as reported Wall Street E in earnings? Or did you actually use the real cash earnings generating ability of the company, which is not what GAAP accounting reports. I mean, every great investor worth their salt for the last 30, 40, 50 years, going all the way back to the second president of the CFA Society, the great investor Shelby Davis, had been saying you can't trust GAAP accounting. It hasn't gotten better, it's gotten worse. Right? And this is one of the problems, is that if you look at profits break out at companies, right? At companies where it's based on the cash flow earnings power of the company and not the GAAP accounting, you will see the right companies to buy. And you'll be able to sift through it right away and say, oh, that's why these companies are doing so well. That's part of the anomaly that occurs in this time frame, is how divorced the as reported numbers get from economic reality.
Yep. I mean, I think that, when you look, I think that's a really important thing is, so often in the midst of a boom like this, it's very easy to look at a lot of the companies that are running and say, wow, they literally aren't making any money at all. The frequency with which we find companies with uniform accounting, right, Joel, that either return on assets on an as reported basis, right, how we look at things, or just looking at earnings, to your point, are negative, right? Especially in tech land and everything else, we've got things like stock option expense distortions, R&D distortions, and everything else. It's so clear that when you have to use a uniform accounting to get there, 100%.
The R&D is the big one, man. I mean, of all those. So this is what the accountants do. They punish the innovators. And so if you have a company that's generating more and more cash every quarter, generating true cash every quarter, right? You'd say, oh, that's easy to find. But if that same company is like, we're going to be the market dominator, we're going to own this market, and they start pouring that money into R&D and to other investments, right? They start, I'll say, renting more assets or whatever. The accountants treat that like cost of goods sold. And you're like, so suddenly the company looks like it has falling cash from operations, when in reality it has rising cash from operations and rising investments because they love the business they're building and they're taking the money and they're putting it back in. And so the problem is these traditional free cash flow people, right, we're saying, oh, the company has falling free cash flow. Like, well, hold on a second. Is the free cash flow falling because they're not making money? Are they making money like crazy and they're investing like crazy on top of it? Right? And that's what got people, why they missed Amazon in the early days, why they missed Netflix in the early days, when they missed all these companies that have doubled and then doubled again and whatever. It's because they kept going, oh, this company's overvalued, it's in a bubble. Like right now, people calling for an AI bubble way too soon. And I'm like, yes, if I was still using GAAP accounting, and if I was still using an earnings number that showed investments as a 100% expense, I might think those companies were doing worse also. Instead of saying, no, wait a second, these companies are actually minting money, they're just investing like crazy. That's a good thing, right? It's like the difference between a good negative free cash flow and a bad negative free cash flow. If the company has negative free cash flow this year simply because they're investing like crazy, it's because they know they're going to have massive positive operating cash flow in the future, right? But if the company's like just saying, well, I mean, let's say they have just too much cost of goods sold in SG&A, not including investments, well, that's a different company. And that's how you chip between them. Because when these stocks take off, Rob, like this, and this is the thing. When these stocks take off, some of them just take off because they've got the right. Remember that Long Island blockchain? When everyone's talking about blockchain, they just had the right name, they had the right story, and they get hyped up. Well, how do you tell the difference between the companies that are just hyped up and going up and they're about to crash, or the companies that are truly, yes, getting hype, but they're actually minting money, but you can't see it because of the GAAP accounting. You run uniform earnings on it, and you see those profits, and suddenly you're like, okay, now I know the difference between the two, and that gives you an unbelievable edge. Unbelievable edge.
And I mean, everybody, for context, when we were doing our research on this phenomenon, right, on the doubles anomaly, what we discovered was if we overlaid just uniform accounting on top of that idea, we said, hey, in the middle of a bull market, let's wait for a company to double. If we just overlaid uniform accounting on top of that and said, all right, what does it look like if we actually say, now let's filter out the companies that don't have real earnings growth, don't have real true profitability, and aren't really reinvesting in their businesses, and let's just focus on those companies? Two really important things happen. First, we increase our odds from a coin flip that the company is going to double again, which is our goal, to find companies that are going to double again. We go from a little bit above 50% of coin flip to basically 60% or better that we're going to hit it. And two, we go from the average return being north of 120% to the average return being north of 160%. So we improve our hit rate and we improve our results. And that was what was so powerful when we put that together, is that when we get that idea of seeing a company that's doubled in the middle of the bull market, uniform accounting is confirming that it really is seeing accelerations. That's what we call the breakout zone. The breakout zone is when we have found these companies that we think it's a no-brainer that these companies have the opportunity to double again and go a lot higher, just like we saw back in the dot-com boom, just like we saw in the 2010s, just like we saw in the 2000s. We could find this.
Well, that's
Joel.
That's the point.
Yeah,
is in 96 and 97, people were running around screaming, "Oh, the market's in a bubble. Everything's too expensive." Partly because even back then you had the same
Alan
issues where
Greenspan.
innovators. Yeah. Alan Greenspan said irrational exuberance, and then what did the stock market do for another 3-4 years, right? I mean, it went up another 300% or something like that, the NASDAQ, right, or more. The S&P also went up like crazy. And so when we're looking right now at companies, and the research that we're showing is that there is a pattern, there is a system to how to pick these winners, which ones will most likely double again, and which ones will crash, and getting you in and out of the right ones. One of the things that you notice is that valuation by itself, I mean, particularly using GAAP accounting, but even if you did proper valuation using true, earning power based on uniform numbers, even if you did that, you have to get in this mode that I learned from Richard Driehaus many years ago, who's probably the father of this kind of investing market. He had 30 years of performance that he did something like 30% compounded. I mean, fantastic. He had another fund that did 20 years of like 28% compounded returns over the course of those 20 years. And he used to say something, and I actually asked him to sit in my class, to speak in my class. He actually sat in the class, and then he spoke in my class. It was an MBA program in Chicago, and Drio said, everyone told me when I was growing up, you buy low and you sell high. And he said, but I've learned that you can also buy high and sell higher. And you have to get comfortable with some of these companies because the as-reported earnings number will make them look like they have high PEs. And you have to get comfortable with that, saying, everyone's going to say, oh, that company's too expensive. That company's in a bubble. That company's part of that sector's bubble or that AI bubble or that whatever, right? They like throwing around the word bubble. And you find that bubbles burst a lot later and last a lot longer than anyone thinks, if it really is a bubble even, versus could it just be we see fundamental momentum of companies, and that's really what defines the stocks that have price momentum.
Yep. And Joel, I mean, I think that's right. Bringing up Driehaus is perfect for this because as we were all talking about this internally, as we were doing the research, and it was just so glaringly obvious how powerful this mechanism is, we were all debating this idea of like, why is it that investors miss out on these big moves when it is just so obvious when you see it happening in front of you what's going on? Why don't you give everybody context in terms of what we all kind of came to the conclusion as to the why?
It's the opposite of FOMO, right? It's not fear of missing out. It's FOGI. It's fear of getting in. Because once you see these stocks go up so much, you're like, the stock's up 123%, and then we would say, okay, we're going to recommend it. And they're like, but it's already gone up 123%. And we're like, yes, and we're recommending. One of the things in the presentation, right, at profitsbreakout.com is that we got Whitney Tilson to join me on this show because Whitney's a legend of Wall Street. If you've watched any of the Berkshire Hathaway shareholder meetings, he's often one of the commentators at the beginning, the pregame show, if you will. It's almost like the Super Bowl of the year for investors. That Whitney Tilson for the last, many years has been the opening commentator. And he's run a hedge fund. He's run his own money. He's been an advisor to some of the top hedge funds and billionaires, right, in Wall Street. And he was looking at this research. He was like, this research makes all the sense in the world. Because we're showing him to say, well, you just want to get your thoughts on it. He goes, no, this makes all the sense. I mean, he doesn't have the database we have, but he said anecdotally, company by company, right, he was thinking at his best stocks weren't stocks that went up 100% and then he sold. There were stocks that went up 1,000% and he rode them as they just kept going up and up and up and getting, as people said, oh, it's in a bubble. And it's like, yeah, and then it doubled again. Oh, no, it's in this bad situation. And then it doubles again, right? So why not take advantage of that? But I just think that a lot of investors One, they've got bad data. Two, they're listening too much to Wall Street and the Wall Street media complex. And it's going to unfortunately keep them out of this market that they really need to be in, if they're in the right places in the right ways.
And if memory serves me correctly, Joel, too, I mean, Whitney even highlighted that if he looks at his biggest regrets in investing, it's oftentimes the times that he didn't let the mo run, right? He didn't let momentum and stock momentum and fundamental momentum run. He said, oh, I got a double, let's take it, right? And Amazon or Netflix, I think it were examples that even gave of that, right?
Yeah, he's very open and honest about saying some of his biggest mistakes were making money too little, because he was like, all right, I made money on it, but man, if I just stayed in, right? The problem is, how do you know which ones to stay in when you hear the media saying everything's in a bubble, you hear Wall Street, giving you recommendations that are just terrible, you know what I mean, in terms of what to be doing in the markets. Goldman, if you remember, Goldman had this thing called the negative earnings index, and they had all these companies at negative earnings. And they were talking about, Goldman Sachs said this, look at this negative earnings index and all these stocks that just keep going up. And we looked at those companies and they're like, these are innovators that on GAAP accounting looked like they had negative earnings. But when you fix that R&D and the new investment issue and said, wait a second, let's separate between, is it positive earnings with a lot of investment or is it negative earnings? Well, Goldman didn't discern between those two things. They didn't. So they just said, oh, it's in a bubble. And they were wrong, obviously, right? And a lot of Wall Street's going to be wrong again on this one. And unfortunately, too many investors pay attention to Wall Street, not realizing that if they really were any good, right, at investing, the people talking to you from Goldman and UBS and JP Morgan Chase would be running hedge funds. They'd be running money. They'd be in research. They wouldn't be, going on television and saying, here's my buy-sell recommendation. And by the way, it's free. You can get the recommendation for free. I'm like, really? Your recommendation's free? How good is it? What's your track record? 49%. I'm sorry, you've been studying this sector for 20 years, and your track record is 49%. So it's worse than random. Yeah, it's worse than, and that's the case,
So everybody, really quick, if you want to say, just again, if you want to see the full special report that Joel put together with Whitney, you can go to profitbreakouts.com. Again, you can read the link below and click it. Just for context, everybody also, right, as you can even hear as Joel and I are talking about this, these are not, we're not talking about trading options. We're not talking about trading crypto. We're not talking about trading penny stocks. We're talking about trading stock leadership here, and right, identifying which stock leadership is real. So these are real companies that we're talking about here that you can see this kind of opportunity to be able to effectively have the opportunity to shoot fish in a barrel when it comes to find doublers that we've uncovered here. And so, Joel, the obvious question, we kind of hit on it a few different ways, is, okay, so we don't think that we're in the middle of a bubble now. And so many people ask, well, how much longer can this last, right? The dot-com boom lasted for 6 years. The bull market into the great financial crisis only lasted 4. Post-Great Recession, we saw an 11-year bull market. COVID was plus or minus 2 years. And so, and I think that if you're going to talk the idea of riding a bull market, of course, you got to know, as Chuck Prince from Citi used to say, when the music is going to stop. And I think that's an important thing that not enough people talk about when you talk about the idea of momentum investing. Can you tell everybody a little bit about how we think about conquering that problem and how we think about being able to let you know when to go and let you know when to stop?
Well, that's it. I mean, when you were doing this kind of research, you need an investor. This is not buy and hold and just sit in the name for 5 years, right? It's taking advantage of a growth and momentum opportunity where companies are becoming leaders, and then honestly getting out if the fundamentals change, right? And saying, I'm going to get out of that name and take my winnings. And having the discipline to sell, not just because the stock has gone up, but because you're monitoring the fundamentals, and the fundamentals don't have the momentum they used to have. And the fact is, if the fundamental momentum goes away, the price momentum will eventually go away. It will. And so monitoring that and staying on top of it is one of the main ways to say, okay, here's when something we thought was going to double and double and double again ends up doubling, and saying it just, kind of plays itself out. But again, it's its price momentum is mirroring the true fundamental momentum of the company. And the problem is Wall Street is always behind on this. For that matter, the credit agencies are behind when looking at these things. The mainstream media is famous for saying, hey, look at this company that's up. I was like, well, why don't you tell me it's going to go up ahead of time? They're just reporting what happened. And then they sit there wondering, oh, but it's so high now, maybe it's going to stay there. And it's having that discipline of the fundamental momentum is behind the price momentum. And when one stops, then expect the other one to stop and be prepared to sell.
Exactly. And I think that's so important, everybody. Because we're using uniform accounting, we can see that. And that's true on an individual company basis. But the other thing that we really have spent, I mean, Joel, this is, I'd argue, 20 plus years of research on your part, plus or minus that on my part, building, our understanding of being able to leverage our uniform accounting data on an aggregate basis, but then our other tools in terms of understanding the key drivers of macro cycles from credit, from earnings growth, from investment, from the consumer, and everybody, we've created what we call the macro weather report. And what this is it is a tool to help us understand, look, nobody's ever going to get you out at the top of a market, just like nobody's ever going to get you in at the bottom of a market. But if we can figure out when the market's only down 10 to 15% before it drops 50, and we can figure out how to exit stage left as a whole, right? Along with, Joel, to your point, everything that we can do from an individual company perspective, that's one of the things that we found, and we looked back and we leveraged this macro report over the last, I want to say, dozen or so recessions, and we were able to basically use that. And so everybody, this is the important thing, is we're not just helping you understand when to get in, when the doubles anomaly tells us to get in. We also have a really sound process from both the individual company perspective and the macro perspective to get you there. And so, Joel, look, we could take everybody through the entire pitch, but that's why we have the whole entire special report on there. But you touched a little bit on Richard Driehaus. You touched a little bit on the performance that he had. Rest in peace. But the Driehaus, Driehaus Capital has had as really focusing on a growth and mo strategy. I think it actually be great for everybody to hear a little bit about your story from Richard Driehaus was a client. And you got to participate in a true growth and mo trade. Thanks to Richard, related to VIPShop. You want to tell everybody just kind of how this kind of trade can play out in real world experience?
I remember Richard asked us to look at a company using our uniform accounting analysis, using our earnings called forensics, because we also do this audio analysis of management teams, which works in any language. VIPShop, VIPS, was a company that was selling brand new but second or third season goods. So product from 2 seasons ago, right? That kind of thing, or Dolce & Gabbana, but from 4 seasons ago, but still brand new and not counterfeit, right? I mean, it was good stuff, but you were able to buy stuff on the cheap because you're getting goods that the retailers didn't want to hold, but were still perfectly good high brand names. Anyway, so Driehaus, I remember saying to me, he goes, "Hey, once you start looking at the stock, I don't mind if you buy it alongside me." So at one point, Richard and I were together the third biggest holder of VIPShop.
Without course, you, yeah.
Without me, Rich would still be the third biggest holder of VIPShop. But either way, I put some money behind it, and with his blessing. And one of the things we saw was, even though VIPShop had negative earnings, that on a GAAP basis, it looked like they were getting more negative. But on a uniform basis, every quarter, they were getting more positive and quickly, meaning it was a startup. But you could see positive fundamentals in the startup that you're like, this is going to break through profitability, right? Think of profitsbreakout.com. This is going to break through profitability, right, into being an amazing company. And so when we looked at those improvements, now, of course, because it had a negative earnings number, it had a negative PE, which would make every investor go, "Oh my goodness, it's a negative PE. That means it's like infinite. This is a horrible business. It's too expensive." Like, yeah, but people are buying it because of where it's going to be. And when you looked at what the valuation required, it only required the company to just get slightly profitable and just hold there. It wasn't expecting the company was going to continue to ramp up the way it was. And man, every quarter was getting more customers. It was doing more sales. It was having higher per basket sale, meaning people that are coming in were buying more stuff each quarter. And as we track that, along with uniform earnings, which properly puts investment as an investment and not as an operating expense, you had an unbelievable trade. Actually, my best personal trade also, and plus in a short amount of time, I was up like 750%. Those are the kinds of stocks that we're looking for now, right?
And because that's the important thing too, is right. The reason why it even popped on Treehouse's radar, everybody, was because it had already doubled and it was starting to take off before we even did that work that Joel led to him getting I want to say 10 bagger and you getting a 7 bagger. And so everybody, again, if you want to hear the full special report that Joel put together, go to profitsbreakout.com. You can see the link below at the bottom of the screen, and you can see the full breakdown. But Joel, just before we wrap, because we are pushing 30 minutes here, final question for to basically be the audience's avatar, if you will. If somebody is still on the fence, what would you say to them to explain why it is that the time is now to be paying attention to this?
Well, you got to check at profitsbreakout.com. Go check out the show, the interview with Whitney, because he and I go back, 30 plus years of our experience, and we didn't work together until maybe only 4 or 5 years ago. And so we just had this interesting experience of weaving through and seeing these patterns that are developed in the market, and saying, how confident you can be if you use the right tools and the right system, which is just antithetical to what Wall Street and the mainstream financial media do.
And I'd say it's that, and then also, but if I were to look at it, right, I think about, we are in this, this kind of crosshairs right now. The Fed just cut interest rates, right, in terms of, which is, quite frankly, something they should have done from the economy, but really turbocharges the ability for a lot of these companies to invest. And we're seeing breakout momentum. If you look, everybody, I don't know if you've been paying attention to the market, but the S&P 500 alone basically rose, better than 10% in the span of a month and a half, 2 months, going into the Fed cut. And we've got earnings season looming where a lot of these companies are going to be talking about this momentum. And that's why, right, Joel, we all felt it was so urgent. But everybody, if you want to hear more, you want to hear the whole story and hear what's the action we think you should take because of it, check out, again, profitsbreakout.com. And Joel, thanks as always. It's a pleasure always having these conversations. Thanks, everybody. That's this episode of the Altimetry Authority.